Hello, this is EPI Advisor. Today, we have prepared the fund bill for you. Bill is managed by SPDR, a fund management company affiliated with State Street Bank. Its benchmark index is the Bloomberg 1 to 3 month T-Bill. Given its very short maturity, this fund can be understood as an ultra-short-term U.S. Treasury fund. With U.S. Treasury rates currently at a relatively high level, this fund's biggest advantage is that its interest rates are higher than most savings deposits. In terms of investment composition, it secures stability by buying U.S. Treasury bonds. Practically every week, as bonds mature, the fund continuously redeems U.S. Treasury bonds and reinvests the incoming cash into new bonds, which should give you a clear understanding of the fund's structure. Due to its combination of high interest rates for short-term funds and stability, the fund has grown to a size of $34 trillion. With an average daily trading volume of nearly $1 trillion, it is considered one of the large funds. The interest rate is also quite attractive at a policy rate of 5%. However, when we look at the management fee, it is about 0.14%. In high interest periods like now, the interest compensates for the cost. But in scenarios like quantitative easing and zero interest rates, you might end up paying fees without earning any interest. So, it's important to reconsider how to use this bond fund during zero interest rate periods. Another point to note is that U.S. citizens pay taxes to the U.S. tax authorities on their domestic investments. However, for foreign investors in the U.S., the tax obligations differ. BIL is an ultra-short-term bond ETF with a duration almost converging to zero, strictly speaking, around 0.1 years, and the interest rate is at the 5% policy rate level. This is a very good period, with shorter maturities and higher interest rates compared to other bond funds. However, a point of caution is that ETFs like SHV, which invest in U.S. Treasury bonds of less than 1 year, have recorded almost the same yield as BIL. If interest rates are sharply reduced or increased, the yields may no longer be the same. While there's currently no significant yield difference between the two ETFs, it's necessary to take advantage of potential yield variations due to changes in policy rates. This is because, with the start of interest rate cuts, there will be performance differences between bond ETFs, and differences can also arise based on maturity. Ultimately, you need to examine opportunities where yields can improve by leveraging the individual bond and maturity-specific impacts. Today, we introduced the ultra-short-term U.S. Treasury ETF, BIL. We plan to share opinions on how to utilize different U.S. bond ETFs in future investment strategies, so please stay interested. Thank you.